Thank you, Jason. Appreciate it. Hello, everyone. My name is James Burns, and I have a unique perspective because I not only have the work operating a consulting practice in the U.S. that works with venture-backed startups to help them break through barriers to success. I'm also the interim CE and a trustee of Ministry of Awesome, and have been for the trustee for the last 6 years in Christchurch. For those who don't know Ministry of Awesome, we are a founder growth program operator that works across the country with partners like Creative HQ, Grid AKL, and many other ecosystem organizations to help founders identify ways to drive and find product market fit and commercialization. In the States, my firm is focused on helping venture-backed companies where they are struggling to find commercialization success or have hit glass ceilings to break through. And so I literally spend my day from generally 7:30 a.m. US to about 4 p.m., 5 p.m. New Zealand, which is quite late my time, talking with founders, talking with individuals in the early stage space. I love startups. I love the early stage space, and I love helping founders find product market fit. I often get asked what's the biggest difference between the US and NZ startup ecosystems, and of course there's tons. And all of you that are, I know there's a few Americans in the room. I know there's plenty of you who've done business in the States. So I won't pretend to detail or list all of them, but there's three that I always call out on. The first one is, in the United States, corporates often see startup innovation as a growth engine. They see companies breaking through barriers and creating new technology as an opportunity for them to move faster and more quickly at a lower cost of entry to drive new innovation than doing it themselves. They also see failure in America as a badge of honor and an indicator of learning, something that those of us in New Zealand oftentimes struggle with. We see failure in New Zealand as too often a thing to hide from. But in the US, we embrace it. In fact, in many cases, you'll sit in a group of founder meetings and we'll brag about how big a failure we had and see if we can one-up each other on who made the biggest mistakes, which is a totally different attitude. And I think the other thing, and the one I want to dive into probably first and foremost, is that in the States, startups yield more startups. People get into the startup ecosystem, they get inside of a high growth organization, and they get inspired to pursue it. And we have a culture where if you work in one, you could do one yourself. And that's not something that we see as often in New Zealand. In fact, with exits, oftentimes what happens in New Zealand is that if we finally get an acquisition, a few employees or get some particular wealth event opportunities for themselves, what do? They go buy a house and put that into an asset that maybe has less tax implications down the road versus investing in the next big thing. And if there was something that I could spend a whole day talking about, it's probably how in New Zealand we don't create a tax market that incentivizes innovation in the same way that we do in the States. And that by itself is probably one of the biggest things that hold back New Zealand from its abundant growth opportunity. When I say startups in America yield more startups, a little stat I found interesting, 2001, the top 15 largest fintech startups have produced 2,600 new founders. That's new companies spinning out of just 15 entities. And of those 2,600, 12% of those individuals created another fintech venture. The remaining 88% went on to start other types of companies. For reference, in New Zealand, we have a little less than 9,000 total employees working in the fintech sector across the country. So more founders have been spun out than most of our best companies have created in total employees. Just for a frame of reference, companies like Zillow, Credit Karma, Venmo, Stripe, all those companies generating hundreds and hundreds of founders themselves, with some with large market caps, but others quite small at the time of their first exit. Now, US, of course, dominates fintech investment. I was really pleased. I had to check when Dan was giving data there earlier in his presentation. I had to go make sure my numbers matched up so I wouldn't get called out later, since I'm not there to defend myself. And I'm pleased to say, Dan, our numbers match. So that was a good, our research is the same. US, of course, between the US and the UK, driving 58% of all the deals and investment in fintech last year. And it's really dominating. And why do I bring it up? Not because I'm in the States, but because there's just so much abundant interest from investors in this sector because they see it as a long-term global return opportunity. The US will account for 32% of global fintech revenue growth by 2030. And of that $52 billion that was invested in the first half of this year, The US had well more than half of that with $36 billion. So I think it's, as an investor, as a founder, if you're not looking to the States to look for investment opportunity and look for deal flow and looking for customers, you're missing a huge place where fintech has been wholly embraced and is growing at a rapid pace. So I recognize there's a wide variety of people in the room today, and I'm going to try not to talk down to anything, and I'm not going to try to get into too much detail, but I'm happy to dive into detail for anyone who wants to cover it. I thought we'd look at a few key trends fintech startups are pursuing so everyone can get an idea of how big and how diverse that marketplace is. And of course, AI dominates everything, so I could probably do another 2-hour talk just on AI's penetration within the space. But I think what's most important is that whether it's across regulatory activity, customer support, developing code, creating documentation, reaching customers in the space, AI is by far the biggest leverage opportunity that exists for companies to find scale and high ROI with a lower cost. Personalized financial services have solutions that are helping analyze vast amounts of customer data to get valuable insights. Machine learning algorithms are offering personalized financial advice today and producing recommendations based on profiles and purchasing behavior. Transaction monitoring is allowing AI systems to help monitor transactions 24/7, identifying suspicious activity, fraudulent transactions. Machine learning models can even detect the smallest anomalies in what is normal consumer behavior, which create tons of opportunity for safety. And I think in general terms, the opportunity to use AI to do decision making and modeling that today takes human resource time substantially longer is where we'll see a lot of growth. And for fintechs, they're very well suited to benefit from AI more so than their traditional banking counterparts. Why? It's because they're a digital first organization. And more importantly, they're built to be lean and make decisions quickly. And it's that mentality in the States that I don't see enough of in New Zealand, particularly in traditional banking sector, where we're jumping into the opportunity to innovate. We are letting others do most of the work. And then when it's a safe bet, diving in, which is a huge missed opportunity. Now, earlier, there was a question about the size of reg tech and how much it's growing. I don't know who asked that question, but good on you. I came prepared with data on that one, in case you're wondering. The projected compounding or growth rate of this industry over the next 8 years is 23%. And really, reg tech, or regulatory technology, for those who don't know the term, really relies on offering cloud computing and software as a service solutions to help businesses comply with regulations across any part of their business. Of course, AI is going to drive a huge opportunity in this space. And what's interesting is we've seen since the COVID-19 pandemic outbreak, fraud cases in nearly every sector have skyrocketed in line with also the e-commerce boom. So machine learning, AI models, analyzing multiple factors to identify potential fraudsters before they can do any harm is a huge opportunity for the space. And there's a lot of companies right now trying to focus on that in retail, as well as B2B and banking scenarios. One case that I was reading just the other day reported a 20% reduction in the investigative workload for one bank when combating fraud simply by using AI tools that weren't existing 1 year ago. Another interesting thing we're seeing a lot more of is virtual bank cards. Have you seen these yet? These are great. Digital credit card, debit cards that live in an e-wallet, but not physically in your pocket. They're offered by lots of neobanks, Revolut, Monzo, Monobank, all those players. And even traditional banks in the States now are starting to get on board with those. Bank of America, Capital One, some of the largest institutions. They offer unlimited options for personalization, for branding, niche delivery of credit lines for very specific tasks. And of course, the main benefit of virtual cards versus the physical version is that customers can pay with them in-store via their NFC on their phone or any online platform without the risk of losing money to traditional credit card fraud schemes, because those numbers can be generated on the fly and be changed rapidly. In fact, every purchase from a virtual credit card can be authorized and then changed out for the next transaction, so you never have a chance of fraud. There's a lot of really cool companies, Ramp, Marqeta, Bento are a couple that are doing that now. And there's going to be a big opportunity within New Zealand for niche brands to enter this space. Embedded tech, of course, is where the real growth is. And embedded tech is a pretty broad topic. Let's talk about it in the context that embedded finance refers to companies who are not financial institutions, to include financial services or financial products in their digital products. Now, the concept of embedded finance is nothing new. It just really is the next revolution in terms of payment modeling, because it doesn't just refer to B2B plays, B2C plays. It's also referring to B2B. There's a ton of growth in embedding the ability to purchase items. A study last year actually identified that 50% of enterprise purchasing agents in corporate environments were willing to pay for direct purchase of goods or services in amounts in excess of $50,000 per transaction through embedded payment processes on platforms. So a huge opportunity there. A lot of non-financial entities are now offering traditional banking services using the open banking APIs. I mean, Tesla offers car insurance now with each Tesla car purchase, just as part of the click-through process when you make your purchase online. It's not leaving for another entity. It is getting it in the same streamlined customer experience. Buy now, pay later is coming, and in strokes that are at an incredible pace. There's a version, what we might be called 2.0 is here, where it's merchant finance, not banks. So one of the things that we're seeing now in the States is a few companies beginning to take on the credit role for smaller relationships within their customer base. They're willing to take the profit, and as opposed to giving it to the bank institution by giving out a line of credit directly. They're also, of course, working with third-party banking institutions to manage that credit flow. But we're going to see, I think, a lot more of buy now, pay later in terms of both corporates offering that in the B2B sense as well on the consumer side. Housing is a big issue in New Zealand in terms of affordability, and it's no less the case here in many places in the US. And prop tech and fractional ownership is here, and it's starting to really, really explode. Mortgages account in the U.S. for nearly 70% of all loans issued to U.S. households. That was over $12 trillion at the end of last year, which is a massive amount and a big opportunity for improvement in terms of digitizing. Mortgage loans remain heavily bureaucratized here, just like in New Zealand. So digital mortgages are beginning to be more interesting. Prop tech companies offer ways to reduce the time and effort to apply for a mortgage, get approval, and even repay it. Fractional ownership is now allowing multiple investors to collectively purchase shares or fractions of a property that will lower the entry point for homeowners to get into a house, where they're both sharing in the upkeep of the home cost, but also the benefits of its value upon exit. Companies like RealX, Fraction, and RoofStack are doing really well in that space, and I suspect there's opportunities for that to expand greatly in New Zealand as well. Chatbots, conversational tech. One of my companies I work with in New York City, they are a leader in the space. And what's really happening here is not just the movement of technology to replace a customer service department, it's actually a sales engine and a revenue engine. And so what's happening is that we're moving away from just the structured model of ask a question, get an answer, ask a question, get an answer. We're now where the technology understands the context of what you're doing, can use live language models to be able to understand the context of your question, query a larger set of data points, and then respond back with actions that actually don't just answer your question, but might drive purchasing. One of our companies we work with now works in professional sports, and they are more than doubling the amount of revenue in online purchases through a chat tool that uses AI and capabilities to understand the context of what the buyer wants and deliver them options to do upsells and additional purchase add-ons that currently would have been missed in a traditional sense. So this is a huge swing for many companies, and there's several tech companies now focused exclusively on this for both the fintech sector as well as other sectors as a fintech solution. With open banking or banking as a service, it's already established itself, of course, but it's this rise of APIs. So what we're starting to see now are more and more companies who are avoiding as much technology innovation as possible, instead looking at all the tools that are available and figuring out how to provide solutions to niche markets using the tech stacks that are available from third parties. So there's two pieces here. There's the opportunity for New Zealand companies to be one of those widgets, one of those API calls that do a specific function and do it well as for companies to see opportunity within niches, particularly in B2B, where they're leveraging all this existing tech stack and launching it for a local and then international market. So let's look at it from a consumer side as well, just for a frame of reference. Consumers are using more fintech apps than ever before. 55% of consumers report that fintech apps are helping them weather economic challenges. In fact, most recent study showed that those who consider themselves a fintech believer have an average of 3 to 4 apps on their phone that they're checking regularly as part of their maintenance of what they do to determine where money is flowing in and out of their household and how they're using it to advance themselves, both from an investment perspective as well as daily cash management. The other thing that's also coming out that's really true for these consumers is that these fintech solutions are giving consumers confidence, particularly during uncertain times. And 56% of consumers said that the current economic conditions really make them more focused on using these financial tools to manage their finance. Interesting though, Gen Z is at 65%, millennials at 71%. So these emerging younger markets are wholly thinking about these fintech tools and apps on their device as the primary mechanism for how they're making choices. One study was so aggressive to say that millennials and the new Alpha Z generation are looking at nearly a 90% adoption of making choices on their finances using digital tools, primarily those that are powered by AI. Another thing that's happening as we move to a more diversified workforce that's no longer on the payroll, but on side hustles, contract work, multiple income streams, as well as investment in various categories like cryptocurrency and other assets. The traditional credit score is falling apart in the States as the primary or singular method of discerning if someone is worthy of being issued credit. 63% of Americans say credit scores aren't enough to understand their full financial picture. And so there's several fintechs that we're watching now that are looking at how do we leverage other asset components of how a person uses money, what other assets they own, and how do you track that in a verifiable way using blockchain and a few other tools that allow a more credible source of tracking assets. Of course, bank payment usage will continue to grow. And one of the things that's unique about the US versus New Zealand, we're very used to making payments from our phone to another person, bank account to bank account in New Zealand. That is not and has not been easy in the States for a really long time. It's really frustrating. It's very archaic. Even today, I'll use a good example. I wanted to pay one of my contractors, and we have a fintech tool called Zelle that's connected to my bank, is also connected to my vendor's bank. But I had reached my cap of payouts for this last 30 days because there are regulations and banking rules that the banks have put in place to limit the risk of fraud. So even with the capability, it's still quite broken. And I can't wait to the day when we get past that point and we actually in the States catch up to New Zealand to make passing cash back and forth as easy as just hand me your bank account number. 2/3 of consumers are open to pay by bank, even when credit cards and debit cards are an option. 74% of those when they're millennials. Americans thrive on credit cards. Why? Because unlike New Zealand, we don't have generally in most retail environments, you don't have charges associated with the credit card fees. The retailer tends to absorb those. Also, we have incredibly effective points programs that get people thinking that they're getting a good value using their credit card by earning points and rewards, something that you don't see in New Zealand the same way. Of course, most Americans don't realize if you don't pay your whole balance, the interest rates kind of cost more than what points you get. But nonetheless, I won't spend too much time talking about their savvy on understanding how those mechanisms work. What we see really is that consumers, particularly young consumers, are understanding and managing their finances differently. And this is a trend opportunity for New Zealand startups to come after. As more and more younger generation populations look at their finances as requiring a more focused and managed approach than previous generations, and not relying on debt to be the primary vehicle for paying for things, it's actually what can you afford. That's going to give us an opportunity to have more tools around savvy ways to budget, plan, and spend. Emerging payment technologies are really becoming as normalized as a credit card, which is huge because I would estimate, I don't have a data point for this presentation, that probably 80+% of all transactions in retail just 5 years ago would have been on a credit card. It might even be as high as 90%. Cash, of course, has not been in play for quite some time in the States. What's interesting is that we're now at more than half of U.S. population of 178 million mobile phone users will make peer-to-peer payments in 2025. And yet today, it still isn't as easy as just plopping in a number and hitting send. It requires downloading an app, logging in with your bank, verifying with your bank to get your account set up. It is a painfully hard process to get going, which means older generations still are slow to adapt. The young generation sees it as secondary to just flipping on their device or using the microwave. Sustainability is becoming more and more popular here. There is, of course, still huge lack of prioritization in sustainability, although ESG is taking over with corporates. Voluntary carbon markets are attracting action by consumers seeking ways to offset their impact, and you're starting to see more and more places on e-commerce sites, purchasing of travel, et cetera, where you can buy your carbon market offsets to take care of what you've just made a purchase on. People are cognizant of it, particularly these millennial generation, and we'll see more opportunity for that in New Zealand as it moves forward. So how can we help early stage fintechs grow? I'm going to finish with a couple thoughts because I tried to get through this in a way that allows us time for any discussion or Q&A. I'm going to make a few proposed thoughts. For those of you in the corporate space, learn and repeat. Startup 101. In New Zealand, we need corporates, we need companies to collaborate with innovators early in the process so that both you can learn and you can help them learn at the same time. And you can put small teams in place just as a matter of professional development to collaborate with innovators. Think of people inside your organization who have a potential to be an innovator for you. Let them learn by helping someone else. The other thing is corporates have to be customers. It is one of the hardest things as a New Zealand founder to get a corporate to buy. They are very slow, like, wait if, what if? They're looking for that perfect solution, that exact solution that does everything we need it to be versus the niche thing we're starting with. It is up to us in this room and as an ecosystem to talk with within our corporate circles to embrace startup innovation so we can shorten timelines and open up new revenue streams for these startups, but also for us as companies. To investors, I'll continue to always emphasize invest in curious people, not just startups with traction. Too many of the investment deals that I've seen fall through from really smart, talented people are because early stage investment won't come through because the angel community, I'm being general here, Rudy, don't throw anything at me, I know you're in the room, and a few others are too quick to wait for perfection around traction. I'm all about finding the right people. If you can seek out founders who demonstrate incredible curiosity at the problems they're solving, the tech will work itself out if the team is in a true learning mode. And so we need more focus on the people and less on how far along they've got along. Of course, there's always caveats to that. I'll digress. To founders, the Aotearoa's market is so small, we have to look outside of local regulatory and market conditions for bigger TAMs worth tackling. One of the biggest things I see across Ministry of Awesome founders that come through our programs, including Founder Catalyst, is they're too focused early on trying to solve a New Zealand problem. And oftentimes that market is not ready, or it's just too small to be able to penetrate. So we spend a lot of time making sure they're looking at what is the right market, whether it's Australia, Singapore, UK, US, or wherever, and be building for that larger market when you can. Use the local market for testing, but don't consider it the only place to start. Also, the last of founders, you have to ask for help. I just find a lot of times Kiwis are not as anxious to admit they need help. One thing that I find more apt in the US is a willingness for founders to say, hey, I don't know, can you help me? And that means for all of us, we have an obligation, and that's to give without expecting anything else in return. And if we do that, this fintech sector is going to blow up, and we'll see it happen sooner than later. With that, thank you. And if you'd like to connect me on LinkedIn, there's there's my LinkedIn network connection if you want to scan it with your phone, and I'm happy to chat and take any questions.
Thank you.